John, very good to see you. A really important topic today. 4 ways to address the cost of long term care and medical expenses in retirement. According to Fidelity, the average 65-year-old couple will need nearly $315,000 for healthcare in retirement. That's not even including long term care. Long term care, meanwhile, 7 out of 10 people will need at some point, and that is not covered by Medicare. So, your first option would be traditional long term care insurance. What are the pros and cons?
Yeah, so before we get into options, Aaron, I really want to encourage the viewers. You have to have a talk.
Yes.
And this is the hardest thing to plan for. In my experience, my clients don't want to talk about this. Why? It's probably got the psychological belief of, we're getting older, we're getting more fragile, and no one wants to think about their life
Of course.
in a retirement facility. I always think about that Happy Gilmore, where the grandma has to go into the retirement facility. No one
Right.
wants to think about that. No one wants to think about giving up their independence. However, you're doing yourself a great disservice by not having a plan
Right.
of any of the things that we're talking about in this
Right.
video. Just burying your head in the sand and saying this isn't going to happen to me. Statistically, we know that's not a likelihood, but you're setting yourself up for failure. So the alternative is sitting down and creating a plan with either yourself, your spouse, and it definitely an advisor to understand how you are going to fund this event. Because worst case scenario, you plan for it, it happens, you know how you're going to address it. Best case scenario, you plan for it, you're healthy, you never need long-term care, and you have other assets to address it or to leave to your heirs. Either way, have a plan. With that being said, you mentioned traditional long-term care insurance, right? Having a long-term care plan is just not about insurance. Let me start that right there. But this is your most robust coverage. When it comes to planning, having a long-term care plan, it's pretty simple. How much of that risk do you want on your shoulders, or how much of that risk do you want on the insurance company's shoulders? So this first topic is the most robust coverage you're going to get. However, most people really don't like this option. And there's two reasons why. Aaron, give me one of them. Give me the biggest reason why people don't like this insurance.
Use it or lose it.
Use it or lose it, right? They didn't want to spend tens of thousands of dollars and they never use it.
Right.
So for a lot of people, that's a big issue. The second issue is in the past, a lot of these companies, insurance companies, did not know how to properly adjust the risk factors of long-term care and the cost. So you had these huge premium spikes. I'm not going to say that those premium spikes still aren't happening, but on the newer policies that and the companies that I've used for the few clients that have really wanted this robust coverage, we have seen little to no premium increases. Not saying it can't happen, but I believe the pricing in these premiums is better. So this is your most robust coverage. But yes, if you don't use it, you lose it. And that's really had a shift in the insurance company to come up with other options.
All right. And one of those other options here is asset-backed insurance. What is this?
Yes. So this is, again, you're using an insurance company for part of that risk, but you're buying a rider in either a permanent life insurance policy. And I actually have that. I have a life insurance permanent policy, and it's got a long-term care rider attached to it. Why is this great? Because people say, hey, I bought life insurance, and if I don't use it, well, then the death benefit goes to my heirs. If I do need it, then I have some long-term care coverage. And the way they're going to do that is they're going to accelerate the death benefit. So if you're pulling from the long-term care, your death benefit is going to be reduced. The one thing I would caution people when it comes to life insurance is that, if you're trying to get, as a couple, if you're trying to get that $500 to $1 million worth of coverage and really have that robust coverage, you're going to have to buy a lot in life insurance and
Right.
in death benefit. And that's going to spike your premium. So another alternative on the asset backed scenario is having policies that are more specific to long-term care, either through whole insurance or through annuities. And for a lot of people, these are gaining popularity with my clients because they're able to put maybe a $200,000 or $300,000 premium, and depending on their health, they're able to have the insurance company then double or triple their premium benefit that they put in. So they're going to self-pay with perhaps $300,000, but now they're going to leverage the remaining. In this case, if the couple had a tripler, they're going to get up to $900,000 plus in long-term care coverage for the both. So that's going to protect them from a catastrophic long-term care event. Again, they're self-paying with their $300,000. They understand that, but they're really using that money to leverage a bigger, long-term care bomb, as if one or both of the spouses need it. The other thing that people like this is, perhaps, and I always talk about, in 15 years, what if we have Star Trek type of medical technology where, we can heal our ailments? Well, if you're out of the surrender period, you can just take your cash accumulation or surrender value out of that annuity, and you still have access to that money. Or if you die, the money goes to your beneficiary.
And then your next option would be to self-insure, but this is difficult and risky and very expensive.
Yeah. So I mentioned you're self-insuring with the long-term care annuity because the first money that's going to come out is yours. But this is self-insuring. All the risk is on your shoulders. So you have to give this money a job, a specific job, and you're going to have to budget out for a couple. I mean, I would say at a bare minimum $600,000.
Right.
Then the tricky part comes is, how are we going to invest this money? Because we don't know what tomorrow brings, right? Long-term care is not always you grew old and you fell, and you were like a Life Alert commercial, and now you're in a long-term care facility. It may be, a person in their 40s who gets in a really bad car accident and needs to go to skilled nursing and assisted living for a year or two to recover from that catastrophic injury. So you have to understand how you're going to invest that money. You have to understand that you don't have access to that money. If you are truly self-insuring, you need to park a portion of that money for long-term care. And you have to understand that, again, if you need this money and, as you're getting older, you certainly can't take on crypto in these accounts, because the likelihood with every day is you're getting closer to that long-term care event. So you have to be very careful when self-insuring and investing that money.
Right. And then your last option would mean becoming a dependent, which is the reality of what will happen if you don't have a plan.
Yeah. And, what's the first thing that comes to your mind when you're a dependent? Is it
you lose
being
independence
to your kids?
Yeah.
Right. There's another dependent you can become a dependent of, and that's the state.
Yeah.
And I don't know about you, Erin.
Yeah.
I don't know about definitely not my clients don't want this. I don't know about any of the viewers. How many of you want to lose your independence and have to put that burden on your children? Yes, we took care of, I have kids, you have kids, Erin. We took care of our children. If something happened to our parents, we would take care of them. But, your kids still have to work and they have to provide for their families. And long-term care is a 24-hour a day, 7-day a week, 365-day a year commitment in some cases. So you're really putting a lot of onus on your kids to forego work events, traveling, vacations. It's a big burden on them. And then, of course, there's the Medicaid or Medi-Cal spend down, where you've now self-insured, but you didn't have the funds, and now you're out of money. And, we're not going to go into all the details of what puts you on Medicaid or Medi-Cal, but now you're in, a state facility. Now you're being in a state-run insurance program, and it's not the place you want to be. So, have a plan so you avoid these last two dependent topics.
Mm-hmm. Well, John, what's clear is that proactive planning is key. The best time to buy long-term care plans is before you need them, right?
Yeah.
So have this conversation with a professional, with your family now, so that you can avoid it when it's in crisis. John, if somebody wants to have that conversation with you to discuss these options, what's the best way to get a hold of you?
Yeah. And you said it, have the discussion. Look at the pros and cons. There is no silver bullet to any of these topics. They're just options. And sit down and really calculate and talk through these options with you, your spouse, your kids, and come up with the best option. So if you want to learn more about long-term care, and we covered, Tom and I had a great podcast talking about skilled nursing. And, I believe Tom called the state plan, 4 walls and a bed. Go to our website, www.gosecurus.com. We have plenty of videos on all topics for retirement, including long-term care, podcasts. And while you're on our website, if you have any questions, you can visit the Contact Us tab, and you can click on a 20-minute phone call where we will answer any general questions for you. Or if you want our help, you can go ahead and schedule a complimentary 1-hour vision and clarity consultation.
Great. John, thank you.
Thank you, Erin.